So just real quick, just for everybody's else benefit too, is as probably everybody in here knows, with 1031, you do have that, you sell that property, you have those funds you want to roll it into, but it has to be like kind, right? So it has to be real estate again, right? And I think the beauty, and you're probably going to talk about some of this too, is that if on the deferred sales trust, if I understand it correctly, yeah, you can sell real estate or you can sell the gold mine and then buy other, it doesn't have to be like kind, right?
Yeah.
You could sell and buy,
Actual gold.
Yeah. Or you could sell a business and move that into real estate, or sell real estate and go into a business, or buy crypto or whatever.
So
right?
the
right. So
the pieces of 1031 that are problematic to most people right now, especially, a couple of things that are the kind of the high level top issues, we'll call them. One is you've got 45 days after you sell something to identify. In this market, that's extremely hard. You've got to find something that you want to pay the price for. I mean, you can find something to buy, but you might be a 2 cap, and you're like, well, I'm not going to do that. You got 45 days. Like Brian said, I have to buy real estate. 1031 is all real estate all the time. Zero tolerance for anything else. It's got to be real estate. You've got to replace that entirely, that property, which means you're going to buy something for what you sold for, okay? You're going to replace the debt if you had debt on it, and you're going to close on it within the the time frames that you've got. So got a call last month from a guy selling a building in Nashville for $20 million. He owes $10 million. His tax basis is about the same, about $10 million. So he's got a $10 million gain. He calls me, says, I got your name from my attorney. I want you to do a 1031 for me on this building that I'm selling. I'm going to take the $10 million and I'm going to buy something else. I said, well, no, you're not. You're going to take the $10 million, you're going to buy something for $20 million, and you're going to borrow that other $10 million again. He's like, no, that's not how it works. I said, okay. I said, no, that's how it works. So I don't think that's right. So about 10 minutes later, he calls me back. He said, okay. He said, I checked it out, and yeah, you're right. And that's the reason I'm selling this building is I don't want to be $10 million in debt. And so tell me about this other thing that you were about to tell me about before I cut you off and told you that you were wrong. So we talked about it, and we're in the middle of doing that now because he wants to not go back into debt. He wants to take the $10 million, not pay tax on it right now. Again, for him, $2.5 million that is gone. And not go back into debt and only invest the $10 million, and he may or may not want to do real estate. He's getting out of real estate for a reason, but in the 1031, obviously, like we said, there's no other option. So we're doing this. So the end result is this: he ends up with $10 million in his trust vehicle to invest. He hasn't paid any taxes. He gets to use the full amount. He's out of debt. He doesn't have to replace that debt, and he can invest in real estate if he wants to, but if he does, he can do it whenever the time is right, right? It's kind of like this Cialis commercial, right? Whenever the time's right. So that might be in 6 months or a year or
never
whatever.
thought of it that way.
Or he can decide, I do want to do some real estate. I just don't want to do $10 million in real estate. He might do $1 million in real estate. And the other $9 million is wide open. There's all of the restrictions that make it feel like it isn't great are all in 1031. We're out of that, right? The time frames has to be real estate. Replace the debt. All of that stuff is now gone because we're not in 1031 anymore. We're completely out of that into a different section where there's really not any limitations on what you do or when you do it. So that's kind of the idea that allows you to really diversify, okay? And diversification means different things to different people. But if you're, for example, if you're in the stock market and you say, well, I'm diversified into biotech and pharmaceuticals and this and that. Right now, do you feel diversified? No, right? Because if there's a hole in that bucket, no matter what part of that you're in, you're leaking out the bottom. But if you are in some, fixed return type of assets, you're in real estate directly, maybe you make hard money loans, right? Maybe you do some syndications, anything. You get to truly diversify into lots of different things to protect yourself. And that's a lot of the people I work with are to that point to where they want to really kind of spread it around and do different things. The one other difference on the 1031s, in addition to the having to replace the debt, is if you've got even in a family situation, or it doesn't have to be family, it could be business partners or whatever. So, for example, Pat and Terry might have an LLC together, right? And it's just the two of them, but the LLC owns the property. And I have this come up all the time. Well, Pat doesn't want to pay the taxes, and Terry's like, you know what, I got some losses and some other stuff that's going to absorb that, so I don't want to do a 1031, right? So there's a stalemate, and if there's a stalemate, nobody gets what they want. Well, so a whole lot of the deferred sales trusts I do are exactly that. One of them can do what they want into this to defer the gains. The others just take the money and pay the tax. You get to split the baby. You don't get to do that with a 1031. So that's another one of the main differences that I come up across about every day with people, is trying to figure out how to everybody can get what they want.
What kind of time frame do you have to reinvest those dollars? To my understanding, the IRS puts a wording around it to where you have to show that you're going to reinvest it, not just park it there for years and years.
In which scenario?
Deferred,
For 1031?
Deferred sales trust.
There is no such provision.
Okay, all right.
Nope.
Cool.
You can do whatever, whenever you want.
All right.
All right.
So on the if there's a con side, is the deferred sales trust, is it more costly to do?
Yeah.
Yeah, and I would assume it is because, to me, it's a no-brainer.
There's a whole lot more to it.
Yeah, there's more to it.
But what you get is all of the flexibility of it. So let me put it this way: if you're selling a piece of real estate, and you know that you have a piece of real estate that you're fine with the price, you can buy it, the time frames work out, you don't need a deferred sales trust. You just do a 1031.
Yeah, it's cut and dried. Just.
The deferred sales trust is for all those situations to where either you don't have that, or you're in a scenario you can't do a 1031, right? Where there's you've got other people involved, or the timing isn't going to work. All these other reasons, or you've got debt that you don't want to replace. Those are when this comes into play. If you've got a true 1031 situation you're happy with, we'll just do the 1031, and that's why I do those every day. It's because lots of times that is the case, and I don't ever try to talk somebody into doing the other if the 1031 is fine.
Is there a gain amount or a limit that you would suggest where it would make most financial sense to do the deferred sales trust?
So to make it really feel like it's financially or economically feasible, if your tax bill is going to be $100,000 or more, then it can really make some
It
sense.
makes sense at 100 grand.
Yeah.
Right? Okay.
So, but if your tax bill is $20,000, you're not going to like the structure. It's just in order for it to work, we have to do a lot of things, right? It has to. It's not a complicated structure, but there's substance to it. And if you're going to defer a $20,000 or $30,000, $50,000 gain, you're going to feel like that's probably cumbersome for that kind of number.
Okay.
But if you're at $100,000 in taxes or more, then it can make a lot of sense.
So, sorry, just for my understanding, does the deferred sales trust just operate like a normal trust then? Only that's funded from the sale of that hard asset, opposed to like, let's say, a non-deferred sales trust? Is that?
It's a business trust. Okay, so it's not an estate planning type of grantor trust where you're the.
Where I could just create my own trust.
Yeah, and here's why. There's got to be independence, okay? So there's something called constructive receipt. This is an IRS thing. So you've got actual receipt, right? So if you receive the money, taxes are due, right? If you've got constructive receipt of the money, which means it's the same thing as you had received it, but you don't really have it. An example of that is, let's say you've closed on a property and the money's at the attorney's trust account. And all you've got to do is say, hey, here's my wire instructions, send me the money. Well, you haven't received the money yet, but the IRS says it doesn't matter. there's no obstacles for you getting the money, so here's your tax bill, right? So we design this around preventing constructive receipt, to where we don't get it to the point to where you have unfettered access to the money. That's when the tax bill is triggered, okay? We step into the deal and get it done before that happens. And so the easy way to tell whether you've had constructive receipt is you pick up the phone and you tell whoever it is involved, the buyer or the title company, send me my money. If they say, no, we can't send you your money because this list of things, then you don't have constructive receipt. It's an easy test, right? If they say, okay, here's your money, well then, yeah, all you had to do is ask for it. But if you're not closed yet and there's still contingencies and all of these things, then you call and you ask for the money. Of course you can't get it. That means we're operating in that space to where this still works.
Two questions. What is the average annual cost of the deferred sales trust, and how long can you stretch that out to pay the taxes?
So first is the annual fee is based on how much is in the trust, right? And it's a sliding scale. The top percentage is 1.5% of what's in the trust, and that's for trustee, financial advisor. There's a team that keeps this thing operating to keep the taxes deferred, and then that's between 0 and 2 million, 2 to 4 million. It goes down to 1.35, okay, and down from there all the way down to below 1%. Now, one thing that's important though is that fee is a trust expense, okay? That means that it has to be paid out of the operation of the trust and the earnings of the trust. That's not something you're getting your payments under your note and then paying a bill. It's all net of that already. Yep. And then the second piece of that was,
How long
How
can
long?
you stretch it out?
yeah, so we start these out, the installment sale with a 10-year note, okay, because it has to be commercially reasonable. It has to be just like you'd have in any other deal. So if you went to the bank and you said, I want to do a business loan and I want to do it for 30 years, what's the bank going to tell you? We don't do that, right? They'll do 10 years, they'll do 7 years. So that's what these are based on. But remember, you're the bank. So we're in year 9 and we're coming up on the term of the 10-year note, and you say, hey, this has been working out really great. You say, hey, trust, I'm the bank, and you've been doing really good with this, so I'm going to extend this note for you, just like the bank can. And you can renew it for another 10 years or 5 years or whatever. That 10 years is coming up. You say, hey, you've been doing great. You're paying me like you're supposed to. Let's extend this. So there's no limit to how long you can extend it. We just can't start with an infinite note. We've got to keep it just like you'd have at the bank. If you've got a bank loan, there may be some of you that have a HELOC you might have had for 30 years. But it didn't start out as a 30-year deal. It probably started out at 5 or 10. And as that came up, the bank said, sure, you've been doing well. We're going to renew that for you. Same concept. That's the same thing.
Is there gonna be administrative fees to bump at the end of the term?
No, it's just a simple amendment to the note to extend the maturity date. So there's no cost involved
Yeah,
with that.
so
There's
say
no
you,
financing fees?
Nothing like that.
so say you have a couple $1 million. So then who talks to the trust to say, hey, I'd like to do this with that money?
Okay, so
So,
the independents, you're the bank now, okay? So this is not your direct money. Remember, if you touch it, if you're in charge of it directly in your account, or it's, all you got to do is reach out and grab it, constructive receipt triggers the taxes. But remember, you're the bank, okay? So if I've got a bank loan on my house, can I go sell my house without going to the bank? No, right? You're the bank now. To this trust, you've got a lien on everything that's in this trust. So the trustee, financial advisor, they can't do anything in that trust without your approval because you're the bank, right? So you're involved in those decisions, and you say, here's what I'd like you to invest in. You're not doing that investing directly. The trustee's doing it. But remember, you have full approval over what's invested in, which is another way of saying you get to decide what you invest in, right? But you're not doing it directly. You're not the one that has the money. You're not hitting the button. But it's kind of a veto power, right? Nothing can happen without you because you've got a lien on everything. So as a team effort with the trustee, you, financial advisor, you make a plan for how you want to see it invested.
To make sure I understand, so that 1.5% on $1 million, 15 grand, okay? let's say I decide $500,000, year end, $500,000, I invested over here, so I still have $500,000 left in the trust. Does that 1.5 then does it apply to that $500,000, or is it still the original million?
Good question.
Okay.
So if you have $500,000 in the trust, that means you took out 500 and paid tax on it. You don't want to do that. You have the trust invest the 500,
Okay,
it's still in the trust.
it's still in there, right?
So that's the power of the deferral. You get to invest 500 instead of investing 350,
Understand.
right? So if you take it out, that's when you pay tax. So you want to leave it and let it continue to invest and grow with the IRS's money. You want to invest their money,
Okay.
right? That's what you want to do. So you don't take it out, you just have the trust make the investment. So there's still $1 million in the trust.
And that 1.5 will be applied annually to that 1 million?
Yeah.
Yeah, right, okay.
No matter what it's in, you might be in 10 different things,
Sure, sure.
but the trust is still
But
holding.
collectively, yeah, it's still the
investments in
1.5 on that million each year.
That's right.
Okay.
And
So
you're
Todd
making
said, I
over,
really like this program, and I just renew it till I'm dead. And now, what happens, how is it taxed? Say I leave it to somebody.
Yep, so your asset at that point is your promissory note, right? You may have all had promissory notes. That's your property. You can leave it to whoever you want to, right? You can leave it to your kids, you can leave it to your church, whatever.
your favorite realtor.
My question is, does my favorite realtor have to pay taxes on it, or does he inherit it? at
So
some
he steps into
basis?
your shoes. So he has the same options you had when you were alive. He can say, hey, I like this deal. Give my monthly payments, right? He still owed the money. Only when he decides to let it term out and he receives the $1 million does he pay tax on it. So he can do the same thing you were doing while you were alive and just collect the
So he can
income.
do that and leave it to Carson eventually if he wants to.
There's not any limit to that.
So it's perfect.
And here's the deal, and I get this question all the time. It's a deferral. The IRS is 100% good with deferrals, okay? You've got IRAs, 401ks, you've got pensions, you've got 1031 exchanges, you've got installment sales, you've got all kinds of things that defer. IRS is cool with that because what happens? In the meantime, you're getting interest income that you wouldn't have had otherwise, right? That you're paying tax on, and they know that at some point somebody's gonna pay. They've always been fine with that. And when they've audited the structure, and this happened a few times, all they want to know is, once you do this, are there any trapdoors? Which means, are you deferring this tax and then dropping it offshore somewhere to where nobody ever pays the tax? We say, nope, we've never done that, never will. Somebody's going to pay the tax. And I say, okay, fine. Because that's all, they just want to make sure somebody's going to pay. If they didn't like that or wouldn't allow that, you wouldn't have IRAs or 401ks because that's all that is. You're using that tax-free money that you haven't paid on yet to grow it and make more, because at some point you're gonna pay tax on more. And the IRS is like, okay, we'd rather have you pay more later than some now. And it's the same concept.
So if you invest $1 million, it grows to $5 million in the trust, and you decide to cash out one day, which someday will be, you're paying taxes on the $5 million or the $1 million?
No, you're paying tax on what you take out. So it's not like a Roth to where you don't pay tax on the growth. You're just paying it later. You're gonna pay it. Somebody's gonna pay it. It may not be you, but somebody's gonna pay it.
Still, you have to pay
Now-
more, but it's still worth it.
But remember, so going in, so the character of it stays the same. So for example, if you sell something for $1 million, your tax basis is 500, okay? So you've got a $500,000 gain. That doesn't go away. You still keep your tax-free money, right? But it's in the trust. So that means when you do decide to take money out, 50% of that is tax-free basis of the $1 million anyway, and 50% is capital gains. So that keeps its character. Anything that you've earned over the $1 million is new money that you haven't been taxed on. So that's going to be taxable whenever you decide to take it.
Okay, my parents are 90 and 92. They're thinking about selling their house each in North Carolina. It's probably worth $600,000 at this point. They sell in the next few months. Would a deferred trust be a good idea to do for them?
Is this their principal residence?
It is.
Okay, then they're not going to probably want to do that because they get free money, right? They get a principal residence exclusion that you don't want to give up.
With the $500,000 of free profit. That's good.
That's the best of all scenarios. Right? That's no strings attached, free, right?
Yeah.
Deferral's cool, But exclusion is the best, that's. Yeah. So you've got here's the range of tax stuff. Exclusion, best, deferral, next best, evasion, bad. So that's the scale.
If we go back to his example, you put $1 million in and it grows to 5, is that 4 million delta, is that taxed only when the trust distributes it, or is it taxed as it earns it over time?
So you are only taxed when you receive money, okay?
But is the trust taxed at all through this whole 20-year period?
So here's what we do. We set the trust up to try not to pay tax. Here's how we do it. Whether you take the money or not, we've got a lot of people that say, I don't need the additional taxable income. Don't pay me for a few years, right? Well, if that's the case and the trust has income, the trust is going to pay tax. Well, here's what I do. I elect to have the trust taxed as a corporation for a couple of reasons. One is so we can use accrual method of accounting, which means if the trust earns 8% on that money and it owes you 8%, but you say I don't want it, well, we accrue that expense it to offset the income, and we do it as an interest payable to you. But since the IRS, and again, we use the rules where they lay, all right? The IRS made these rules, we didn't. IRS says you, as an individual, cannot use accrual method of accounting. You have to use cash basis. So we say, hey, IRS, it's not our fault that the trust gets to accrue this and not pay any tax on it, but you don't pay tax because you can't use accrual. You only pay when you receive it. That's not our fault, right? We're just taking advantage of how the system is set up, all right? So you only pay when you actually receive some money. And if we have some assets in the trust that are going to outperform what the interest rate is, okay, that delta is what we try to manage in the trust. So for example, if you're gonna make some market investments in funds and whatever, we can get pretty close on what those are gonna generate. If you've got something that generates 6% over the last 20 years, it's not gonna do 20 all of a sudden. It just doesn't happen, right? But if you want to invest in real estate or maybe a business that it could be 20 or 50% or 100%, here's what we do. We'll have the trust make that investment through a newly formed LLC, okay, that the trust is a minority member of, but you are the majority owner and the manager. You're in charge of this this project, whatever it is. Let's say it's a real estate investment. So we'll have the trust be a minority owner with a preferred return. So the trust, let's say the trust puts in $500,000. Well, the LLC agreement provides that before anybody takes any money, the trust gets its capital back and a preferred return of 8%, okay? So if this project sells out, then the trust gets its capital back and it gets an 8% preferred return, which matches up with what we've been doing in that note. The other 10, 20, 50%, whatever, is up to you to decide what to do with it, right? And so I had when I closed last week that's exactly what happened. But they said, listen, on that other 27% for them that they made on top of what they had to pay the trust, I don't want to pay tax on that either. So guess what we did? We got in before that happened, before the sale, and we did this again.